This example deals with the accounting of directors' fees. So just a quick recap, the directors are the persons that are responsible for running the entity. They are appointed by the shareholders at annual general meetings, and they need to provide strategic directions, and they actually need to run the company. Directors often serve on a board, which is known as the board of directors, and this board provides strategic direction for the company. So here we go. We've got Jongi Limited on 31 December is their year end, and during the year on 25 June 2013, Jongi Limited paid one of their directors, Mr. S. Gumede, 170,000 Rand, and this 170,000 Rand was 45% of their contracted amount. Right, so you'll remember directors get paid certain directors' fees that is agreed with them in a contract, and also there's a remuneration committee that is established that looks after the remuneration of directors to make sure that it's not too much and also not too little. So they've determined that Mr. S. Gumede should get a certain amount in his contract, and this 170,000 Rand that's been paid to Mr. Gumede represents 45% of that contracted amount. So we are required to provide for the director's fees paid as well as the director's fees owed at the end of the year, because obviously he's been paid 170,000 Rand, but he's still owed the rest, the remaining 55%. So in this example, we're just going to look at the 45%, and there will be another video explaining how to calculate the 55% and to account for that. But for now, let's identify our two accounts like we always do, because every transaction affects two accounts. So what's the exchange of value taking place here? My first question is, which two accounts are affected? So the first account affected is we have paid these directors, or this director, Mr. S. Gumede, 170,000 Rand. So the first account is going to be bank. All right, bank we know is an asset. That's the second question. We know that the asset increase or decrease, it decreased in this case because we gave out money to directors. And what does DebtClick say? DebtClick says if I have an asset that decreased, remember DebtClick is for an increase, so for an increase an asset will be a debit, so for a decrease it will be the opposite, an asset will be a credit. Okay, so that's the first part of this transaction. Now the second leg is the actual thing that we have paid here, and we have paid our directors. Now what type of account will directors be? Let's just put down directors fees here. Directors fees. Well, it can either be an asset or an expense, and you'll remember the distinction between an asset and an expense. An asset is something that the entity owns. The entity doesn't own this director. The director has rendered services for the company, and if the company would like those services again, they will have to pay the director again. So it's basically the company has used up the services of the director for that year, and it will thus be an expense because the services has been used fully, and if the company wants to use the director again, they'll have to pay again. So my expense has increased, and we know from our DebtClick acronym that if an expense increases, that has to be a debit. So we can put in our debit here. So there we go. We're going to debit our director's fees, and we're going to credit our bank account. Let's go then to my general journal, and sorry, not the general journal. Let's first account for this in the subsidiary journal. So which journal? This is the accounting cycle. Remember, we first go to the journal and then we do the ledger. Which journal is affected here? Well, we've paid fees, so that's going to be the cash payments journal. So we can put in here our document number, which was not given here, so that's just a generic one. The 25th of June is the day that we paid this. What is the details we need to fill in here? It was paid to Mr. S. Gumede, so we can fill in Mr. S. Gumede. And Then we need to use the correct columns where we've paid out of the bank account. Whenever you do a cash payments journal or cash receipts journal, the bank account will always be one of the accounts affected. You'll either give out money in the cash payments or you'll receive money in the cash receipts journal. Right, so my bank account has decreased, we already established that, by 170,000 Rand. We don't have a specific column here for directors' fees, so we're going to fill that in our sundry columns. Directors' fees, the amount is 170,000. Once we've done our journal, we just need to remember to put our headings, the cash payments journal of Jongi Limited for June 2013. Once we've done the journal, we now need to post this transaction from the journal to the general ledger. So the way that we do that is by using these folio columns. Let's go to my ledger and look at the two accounts that's affected here. The one is going to be bank, and that's got folio column B or folio number B1. That's the account number related to bank. In practice, these are often not how can I say, two-digit numbers like these. They're often a little bit longer. And then the other account affected that we said was our director's fees. So let's go back, and our account is director's fees. We see director's fees is an expense because we've used the services, and we're going to debit that. So let's go back here. My director's fees is an expense, so let's make it an expense. That's an income, sorry. Let's make it an expense. And an expense increases on the debit side and decreases on the credit side. And we said our expense increased by 170,000 Rand. My bank, we said that bank is an asset, all right? My bank account decreased, and the bank account decreases on the credit side. So let's go back. My bank is an asset, so let's color it like that, and it increases on the debit side, and it decreases on this side, and we gave out money, so it's going to decrease by 170,000 Rand. Then we simply fill in our dates, 25 June, 25 June, and we can fill in our contra entries. This one is going to refer back to bank, and this one is going to refer back to my director's fees. There we go. And lastly, we can fill in our folio column, which is what we use to post from the subsidiary journal. Right, so we're going to post from the CPJ1. So we can enter here CPJ. Ooh, that's incorrect. We need to change that. CPJ1. And this one also needs to say CPJ1. There we go. Because we've paid the director's fees. And then in our subsidiary journal, now that we've posted it, we can fill in here N9 for director's fees, and we can fill in here B1 for the bank account. B1 and N9. Right, and that's the posting of the ledger, or posting of the journal to the ledger. Then the last thing that we're going to do is quickly do the effect on our balance sheet. So let's have a look here. And what is being affected here? My assets, my equity, or my liabilities. Well, we paid money, so my assets, specifically cash, is going to decrease. So we can say minus 170,000. Okay, there we go. Then what's the other part affected? You'll remember that your incomes and your expenses will eventually roll up into retained income. So my expenses is going to decrease my profit, and my profit is included in retained income. So effectively, if my expense decreases profit, and my profit is included in retained income, right, then my retained income is also going to be reduced by the 170,000. So that's the effect on the balance sheet. Good. Just want to show you something on the subsidiary journal as well. Remember, even in the subsidiary journal, you can see this effect of double entry accounting. We've always got two legs to every transaction. Here we've got our bank leg, which is the asset, and here we've got our other leg, which is director's fees, which is the expense. So you can always see this double entry effect right from the journal to the ledger to the balance sheet. Every debit needs to have a credit. Every transaction has got a debit and a credit. Every husband needs a wife. So there you go. Right.